Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The ASX 200, Nikkei, Shanghai are trading in the red. Now, what is holding on to the green is Taiwan Index as well as Hang Seng.
Well, but India has, you have to understand, for many years it was a one-sided relationship.
Market seems to be finding a bit of resistance. Yesterday's high is 24,756. That's the first resistance level. 24,600 is where the Nifty is at. It's flat, absolutely flat.
With ease of living and the ease of doing business over a period of time with entrepreneurship and a conducive policy environment, you are going to see a consistent long-term growth. This is my view.
States are very clear that they want revenue protection and a clear-cut direction on protection for the consumers.
From a GDP point of view, is maybe 0.5% at most.
60-point cut on the Nifty. The Bank Nifty too is seeing some cuts. It's been volatile in the last couple of trading minutes.
We would want to continue to focus on operating leverage, cost excellence, and continue to scale with profitability.
For the markets, it's a 36-point uptick that we're seeing on the Nifty, but it has been very volatile. We've been seeing that 100-point range in which the market has been moving.
Okay, well, that is the day so far, and markets, of course, a bit of a yo-yo, right? I mean, got to the high point, was up about 80, 90, 100 points. Then there was a sharp sell-off, almost nothing left, and now we're back up about 85 points. So 24,664 is back on the table, looking a lot better. This is, of course, Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Rima should be with us in just a bit from now. Guys, good afternoon.
Hi, good afternoon. So I guess not bad considering yesterday was that disappointing second half sell-off. So compared to that, I think lower expectations. It's not looking too bad. In fact, the screen, if anything, is it's a reversal of yesterday because for what it's worth, we are at the high point. Now we need to see if these gains can be digested in the last hour. A lot of metal stocks shining, a lot of other large cap names shining from auto, from FMCG as well. So overall, Nigel, not looking too bad.
Well, that's right. And this is sometimes what you normally see on the next day of an expiry. So Tuesday was the expiry this time around. And yesterday, the last 90-minute move could be attributed to expiry. So that could be unwinding all the pain that we saw yesterday, point number one. Point number two, Surabhi, for me today, what is encouraging is not just the broader markets are doing well. The biggest drag on the index is the Nifty Bank. And that's gradually trying to make its way higher, which is encouraging. You want the Nifty Bank first to stop falling, then move in line, and then maybe outperform. It's been a big underperform in the last 1 month or so. So I think those two are big positives for me.
All right. Yesterday's high, and point taken, Nigel, yesterday's high for the Nifty, right? I think that's the first port of call, which is 24,756. We are, I think, about still 100 points away from that particular level. But that's the first one which the market needs to take out. I think as we trade right now, we should be, I think, at the 20-day moving average, almost exactly right now. So the 20-day is 24,692. We're at about 24,670. So about 20 points away from the 20-day, but about 100 away from yesterday's high. And beyond that, I think there's perhaps is more repair, recovery. But it's, next 2 days is going to be interesting because there's a lot of pre-positioning. People are focused on, this sector, that sector, where is the relief coming, GST-related changes, etc. So some stuff being priced in, some will be unwound. There will be sort of excitement in some places. There'll be disappointment in others. So you've got to keep all that in mind. And the other point, right, when is the announcement with regards to GST going to come? Is it going to come during market hours tomorrow? Is it going to be after? And I think that's also, at least from a near term, very near term, for those who are trading these things, is going to be an important factor. Let me just quickly run you through what's coming up here. So stocks are higher. Street continues to look for the GST meeting for Qs, rate rationalization, etc. in focus. Metals are the big mover, and Nigel will tell us more about that in terms of what the hope really is. We have E2E Networks, which is a big mover. There is also NetWeb, which is looking up. We've got some info on both those. TBO Tech, big one, 10% higher. Stocks done well. They've done an acquisition, and Winnie will join us in just a bit to talk about that as well. Rima is here with us as well. Rima, hi.
Hi, I can't take my eyes off the metal screen. Look at what a smart move. 3% up on the metal index, higher for the third day in a row. And that is powering the sentiment today. The dollar index is weakened. There is hope that perhaps some GST rationalization will boost the pure stocks, which, in the real estate space, for instance, building materials, etc. And that's keeping the sector alive. Pharma is another one, up and about. PSU banks are strong in trade. And generally, the broader markets are higher. The mid-cap index is up about 0.5%. The small-cap index is up close to about 0.8%. How should you position yourself in the last hour of trade? Mitesh Thakkar from Bonanza Portfolio is now with us on the show. Mitesh, on the long side, what's the trade for the last hour?
Yeah, I think definitely on the long side. See, good afternoon. One thing is that we have very strong supports around this 400, 350 zone. The PCR is still on the negative side, which means that we are on the oversold side. And therefore, I think, in case this range trade has to prevail, the direction, since we are coming from near the lower end of the range, the direction should be on the upside. So I think with that sense, the market should first head towards 24,800 on the spot, which is about 125 points higher. And once we start getting past that 24,950, 25,000 is a minor supply pivot, which could be the next target. Having said that, on the stock side, Inox Wind is something which is interesting to me. It's, fallen a lot and then did some base building. Around the levels of 137, 138 is now reversing. So it's a conditional buy once it breaks about 146, which is about 1% away from here. I think that will be a big reversal. So buy about that 146 level, keep a stop at 143, look for a target of around 160 plus. And the other one is Jindal Steel. You were talking about metals. I think that's one sector which is looking extremely good. So I have a buy on Jindal Steel. Keep a stop below 1,004 and look for targets of 1,008.
Okay, all right. Those are individual trades coming through at this point in time. But let's go back to the Motilal Oswal Annual Investor Conference, which is, of course, in its third day today. Gautam Dugar was with us earlier when the conference was kicking off. He's back now to give a summation of what he's picked up. He's Director and Head of Research Institutional Equities at Motilal Oswal. Gautam, welcome back. So you told us, you'll tell us on day 3, what are the key learnings? So distill it down for us from a market standpoint. 3 highlights, Gautam. What's the feedback like? And as I said, your takeaways really.
Hi, Prashant. Good afternoon. Good to be here. So, the conference has a long, backdrop of global macro headwinds, tariff, and on top of that, we are all anticipating the announcements on GST. So that was the high point of the conference. Everyone is second guessing what's going to come today or tomorrow. Second, we've had excellent sessions in the CEO track across manufacturing, industrials, consumption, and of course, we had a very prominent speaker on GST too, Mr. Raju Memani. So a lot of speakers highlighted opportunities on manufacturing over the next 3 to 5 years. Consumption, which has been a very weak point for last couple of years, especially the low-ticket consumption goods, that is seeing some interest coming back. Obviously, there is a short-term kicker in the form of GST. So let's see what actually transpires out there. And third, among the plethora of investors I have spoken with over the last 3 days, both domestics as well as FIIs, the eye is sharply on the corporate earnings. When will the corporate earnings revive? Because the macro, the global geopolitics, all of this will keep coming and going. But what truly drives the market, as we've seen in the last 5 years, is corporate earnings. When earnings were solid between 2020 to 2024, with a compounding of 20% plus, we saw market took off. And then in FY25, when earnings were flat, we saw market give 0 returns. So everything else falls by the wayside once earnings come back. And if earnings are not there and everything else is rosy, market still won't respond. So those are a few of the important highlights that I just thought I'll, enlist.
So low ticket consumption is one space where you are seeing a lot of interest, and there is a case to be made for things to improve and pick up. What else? Based on the corporate speak, the corporate interactions that you've had, which are the other pockets that you would be most bullish on at this juncture?
So auto is clearly the highlight. We've upgraded auto luckily just before this whole discussion around GST began. We upgraded auto from being underweight to marginal overweight in July during our preview. And now auto seems to be the biggest beneficiary of the potential forthcoming GST rate cuts. So the sentiment around auto has picked up. We saw that in the month of August. Auto index rallied 6%, and now auto is the best performing sector of the calendar year 25 YTD. It is overtaken banking, right? So clearly there is a lot of sentiment buoyancy out there. Auto numbers are fine for the month of August. There is festive season around the corner. The rural sentiments have picked up, and on top of that, there could be a GST boost. So that is one sector which is clearly seeing a lot of interest. Second is EMS, and for the right reasons. There is huge growth out there, which we have seen for the last 2-3 years. Stocks have done well. We ourselves are projecting 50-60% earnings compounding in many of those stocks that we cover. We cover roughly 8 to 10 EMS stocks. So clearly big opportunity out there. Though the profit pool still remains quite small, but the growth prospects are huge. And what is happening right now, Rima, is in a market where the earnings growth is settling between 8 to 10%, any sector, any company which is doing upwards of 20% is getting disproportionately high valuation premium from the investors. So any sector, like for example, we're seeing huge interest in cement because cement this year is going to post more than 50% earnings growth. Prices are stabilizing. Government has kickstarted a capex. They've front-loaded the capex in the first quarter. So that sector is seeing good demand. Then we are seeing a decent demand in the sub-categories of discretionary consumption. Jewelry, hotel, we had a very prominent speaker in the CEO track on hospitality. The demand is still outpacing the supply out there by a margin of 2 to 3% on a compounded annual growth basis. So hospitality should remain a very, very interesting space still, despite performing exceedingly well over the last 4-5 years. And then lastly, I'm seeing some interest emerging in technology, not necessarily the traditional legacy tech players, which are growing at 4-5%. So that's not seeing too much of interest, but mid-cap IT is seeing very good interest. Then of course, you know, the likes of QSR, the likes of food delivery players. We had unlisted, food delivery company out there, which painted a very, very bullish picture for next 3 to 5 years, with the category itself growing at 20% plus CAGR. So segments and sectors which are trying to outperform the market in terms of the earnings growth right now are seeing disproportionate interest. We were in a very different environment between 2020 to 2024 when every sector was growing well. So today, the scarcity premium on growth is running at a very elevated premium.
I'm glad you touched upon that last piece on technology, Gautam. Hi. I was just coming to that. Quite curious to know, because I think the market and investors are already looking for new age tech ideas now, whether that is, like you mentioned, food delivery, quick commerce, or even look at some of these stocks which have a bit of a semiconductor play attached to them. E2E networks is one, NetWeb is the other. Some talk of GPUs and servers, which they'll be putting out for some of the government tenders as well. But you tell us, beyond some of the names that you mentioned, anything else that you're looking at in newer age technology? There are more listings happening as well. For instance, from the consumer tech space now, Urban Company is going to be listing very, very soon. So what are you watching out? What's the new frontier of technology or AI, whatever little plays we have here?
So very good point, Sobi. We've seen definitions of the sectors evolve over the last decade. Initially 10 years back, financials was all about private banks, PSU Bank. Then came NBFCs, then came capital markets, then came insurance companies and fintechs and what have you. Same thing happened in consumption. 10, 20, 15 years back, you only had staples. The discussion was between lever and ITC. Then, you saw so many subcategories evolve in the discretionary space that today we have 3 consumer analysts in our team. Now, something similar is happening in tech. If you're positive on tech for the last 4-5 years and you were overweight on the traditional legacy names, you underperform by a wide margin. Whereas the new age tech companies have delivered fantastic returns. We just initiated coverage a couple of months back on delivery. The whatever target price the analyst had for 12 months was achieved today in less than 2 months. So clearly, fund managers, asset allocators have to be on the edge because the definitions are changing rapidly. And if you're evaluating the sector with the past lens, the possibility of you missing out on the new age or, the emerging trend is quite high. So as far as tech is concerned, as I said, if you're looking at tech, then it's very important to identify companies which are at least growing upwards of 15%, because the days when 5-10% growth was attracting huge premium seems to be behind us. In fact, one of the data points I was looking at in December 21, the IT sector had a close to 20% weight in Nifty 50. Today, it is somewhere about 10.2 or 10.3%. So in a matter of 4 years, a big sector like IT has seen its weight in the benchmark index half, right? And it's obviously a consequence of a very prolonged period of suboptimal growth. So you're going to see similar trends evolve in various categories, be it industrials, be it consumption, be it financials, be it technology, or be it even healthcare. Even in healthcare, we are seeing that the modern health tech or the new age, healthcare companies taking market share away from the traditional guys. So the job of an asset allocator has become even harder in the last few years. And as you rightly mentioned, more and more companies are going to list in the next few months or quarters. And who knows, in 3 years or 5 years, the composition or the complexion of the benchmark indices will itself change meaningfully.
Hi, Gautam. Good to see you. When you spotted that delivery and the other one, I think, is car trade. Both of them went ahead and they bought their smaller peers. And suddenly that market itself for them became much wider because the nearest possible competitor was taken over by them itself. That said, we're going to be turning the spotlight on the metal space. And that's moves more according to momentum rather than according to, what's happening on the fundamentals. How are you placed out there? I mean, what's the view? Because the coming months should be very good. For ferrous as well, things will look up because the government is playing its part. How are you all positioned out there?
Nigel, that question is for me?
Yes, on metals.
Yeah, okay. So look, on metals, oil and gas, commodities, usually we've always kept a very underweight kind of a stance because it's very difficult to time those sectors. As of now, we are very selective there on metals. We like Tata Steel, we like Hindalco, and we also heard very positive commentary from JSPL, or I know the name has changed. But look, I mean, it's very difficult to second guess the commodity prices given the churn that is happening globally on both growth, geopolitics, and demand capacity. I mean, the demand supply mix, which is ever evolving. So for now, from our portfolio point of view, we know that the sector has done reasonably well in the recent period, and even the earnings were slightly better than expectations. But for want of predictability, because it's very difficult to predict those commodity prices and the fortunes of the sectors change very rapidly, we generally tend to be conservative out here and keep our positioning slightly neutral to underweight more often than not.
Gautam, let me ask you, at the end of the conference, right, do you have added conviction on something which you were unsure about? From an investor point of view, I mean, I'm sure, stuff which investors wanted, companies which investors wanted to meet. Lots of these names which are kind of beaten down, and maybe it's always the case. People watching closely if there is a turn happening, or any changes broadly in your assessment of companies. If you can name 2-3.
Sure. So, Prashant, look, at a big event like this, when there are 1,200 plus investors and roughly 200 corporates, and so much happening both domestically as well as globally, always going to be a lot of, discussions around portfolio strategies and changes and what to look at, given that the market has been range bound for more than or almost 12 months now. So we've had a decent period of time correction. So a lot of conversations happened around portfolio construction in this times, what needs to change. For example, I'm seeing some interest back on hitherto ignored sector like consumer staples. Now, it can be very opportunistic given the events which are lined up over the next few days, but at least I heard few investors discussing consumer staples, which I've not seen for a long period of time. Similarly, people who have a slightly contra mindset, they're getting, excited about large cap IT because no one seems to be talking about it. And for right reasons, because the growth has been very, very subpar. But those with contra mindset have seen 3-4 years of underperformance of large cap tech, very attractive risk reward in their view. So those are sectors which are seeing some interest coming back after a very, very long time. Amongst the ones which are already performing well and where we have seen renewed and continued interest is auto, consumer discretionary, capital market players. There's a whole host of capital market companies representing at our conference. electronic manufacturing services, EMS, defense, right? We had a very interesting session by former Army Chief yesterday in our CEO track. So clearly, there's a lot of interest in some of the spaces which have already been doing well. But at the margin, to address your query, consumer staples, large cap IT are some segments where after some time we have seen some interest emerged.
Okay, that's some ideas where I think there will perhaps be some tactical or otherwise, but pockets to think about really in that sense. Gautam, thank you very much for joining us and telling us what's been happening at that conference. Very, very busy, 1,200 plus investors, lots of CEO tracks, lots of meetings, etc. So that's Gautam giving us the intel from there. We'll take a quick commercial break here. We're going to come back and we'll have Sudeep Bandyopadhyay joining us on the other side. Markets are holding on 80 points, so 24,660, almost basically at the 20-day so far. Stay tuned.
Welcome back. So the market's trying to hold on to most of the green, at least for now. 100 points, almost 100 points up on the Nifty. As always, it's that time when Hormuz gets us the list of the buzzers beyond the obvious. Hormuz, all yours.
We start beyond the obvious, but then there is one name that has been an obvious choice over the last few days, and Ola Electric is that, of course. Yes, it is. 5 out of the last 6 sessions now that the stock has been higher. Another 10% today. Now, in these 5 sessions that the stock has gained out of the last 6, the stock is up 40%. 42% in those 6 trading sessions. Now, already we've had 75 crore shares that have changed hands today compared to a 20-day average of 30 crore. And a trend over the last 6 days that has emerged is that the daily average volume traded is above 50 crore shares every single day. And courtesy of this move, the stock is also closing in on its IPO price of 76 rupees a share. Now, a not so obvious one is Vimta Labs, and that stock is something that Prashant also highlighted earlier in the morning. Those 4 out of the 5 sessions that the stock has gained, was up 17% yesterday as well, is building onto those gains, 5% higher today. We had almost 1.7 crore shares change hands, a 20-day average of just 21 lakh. Now, the stock began the year of 2020 at 46 rupees, currently stands at 800 rupees. And you take a look at the returns annually as well. The stock, almost in the last 5 years, the stock has doubled in 2 of them, and also YTD, the stock is up almost 60% as well. Of course, mind you, the stock has no institutional holding, neither on the domestic side nor on the foreign side as well. The third one in the list today is NMDC Steel, the demerged unit from NMDC. The stock is moving 10% higher on volumes that have 6 crore shares compared to 20-day average of 1 crore. And as a result of this move, the stock has also gone above its 200-day moving average, which is at around 39.5. And the last one on the list today is Piramal Pharma. But despite the stock being up almost 8% today, it has declined in 4 out of the last 6 trading sessions. Today's volumes, almost 2.5 crore shares traded compared to a 20-day average of just around 23 lakh, and a 50-day moving average, the stock is broken above that at 198, now 201 on the stock. And an interesting nugget that Sudarshan highlighted to me in the newsroom when early in the morning was the fact that the stock has found support at levels of 180 4 times in the last 12 months, and it has reversed from there every single time and has significant returns from those levels. So even this time around, the stock reversed from 180, the stock now at 202, 8% higher in today's session.
Okay, thank you very much for that. Markets are inching higher now at the day's high. It's a 100-point up move on the Nifty now. When we started the show, we were up in the green for just about 30-40 points, and now the gains are getting stronger. It's banks now pulling their weight. Shriram Finance pull up HDFC Bank and Axis Bank, Kotak Mahindra Bank, particularly in HDFC Bank, has seen quite a lift in the last 30 minutes or so. There you have it, all the private sector banks. Sudeep Bandyopadhyay is now joining us on the show. Sudeep, thank you very much for joining in. Let me start with Indus Stars. The stock is still down close to about 2%, but it's managed to trim the losses. I mean, the street is concerned that this whole Africa expansion plan is going to eat into the dividends which would have otherwise come their way. Firstly, does this Africa expansion make sense for a company like Indus Stars? Is it a strategic move? And how would you address the concerns about this delay in dividend payouts, potential delay?
Well, I think, from an Indus Tower point of view, it makes tremendous sense to expand. Post what has happened with Vodafone, I think they can't rely on the Vodafone business going forward for a long term, and they needed to diversify. Their biggest client, Airtel, is already well entrenched in Africa in these particular 3 markets, which they are talking about. So it is absolutely logical for them to go and expand in these markets. I'm sure they will get a lot of support and business from Airtel in these markets as well. So I think from a long-term perspective, even medium-term perspective, I think this is a very good strategy from the company point of view. Yes, from a dividend shareholder point of view, there's a bit of a disappointment as the dividend is getting delayed, and the investors were expecting a dividend, so there's a bit of a disappointment, and market is reflecting that. But I think market will get over it. As a strategy, I think I like this strategy.
Okay, all right. Sudeep, I wanted your view on metal stocks. But first, let's run our viewers through the 5 probable reasons that, in fact, metal stocks are buzzing today. The US Fed could be heading for a rate cut, as the Fed funds futures, well, they are pricing in close to around 87% probability of a 25 basis point cut later this month. The spotlight now will shift to Friday's non-farm payrolls data, which could determine the pace and the size of the expected rate cut. So that's point number 1. Point number 2, China's anti-involution drive, that's gathering momentum. And the new measures that are aimed to cut excess capacity and curb disorderly pricing in sectors like steel as well as base metals. This in turn could help reduce the supply glut and support global prices as well. Point number 3, China's economic data actually has surprised positively this week. The manufacturing PMI for the month of August came in at around 50.5. That marks the fastest pace of expansion since March. And the services PMI came in at around 53. That was early this morning. That as well beat expectations. Point number 4, India. Well, we have gone ahead and recommended that safeguard duty on steel imports for the next 3 years. That could protect the domestic producers and also remove any kind of overhang with regard to uncertainty. Point number 5, China-India relations, well, they are improving. That's boosting sentiment as well. So those are the top 5 points and probable reasons why metals are excited. Well, company-specific data as well is looking up for the month of August. MOIL, they delivered a solid growth number and they have, delivered close to around 17% growth. But they'll have to up their game to meet their ambitious 20% volume growth guidance that they've set out. So that's on MOIL. Pricing as well has improved on MOIL. On Coal India, they delivered their first positive month after 4 straight months of decline with regard to the dispatches. So the street likes that. NMDC, well, they delivered good growth. That was fueled by the growth, 25% growth that we saw in Karnataka. So company-specific as well, things are looking up. Globally as well, things hopefully are on the mend. So to sum things up, dovish Fed signals, recovering China, India protectionist policy, as well as improving operational metrics, they are creating a perfect storm for all these metal stocks today. So that explains why that index is looking up. Sudeep, are you impressed or not? And what would you buy from the metals pack?
Well, absolutely, Nigel. In fact, I've been positive on metals for quite some time. In fact, I think yesterday or day before on your show, again, I had mentioned that I'm positive on metals. US rate cut was around the corner, and I think that's kind of real now. We will get to know soon. And that definitely supports metal prices. China taking initiatives to prevent the glut and overproduction is definitely music to the ears of the metal producers. Overall, I've been positive on the demand for the metal in India, metals in India, and that's pretty much showing in the numbers which multiple companies are declaring. Look at Coal India, look at MOIL, and look at pretty much every metal-related company. They are coming up with good numbers because industrial demand, infrastructure demand is significant, and that will give a boost for domestic metal producers. And of course, the safeguard duty on steel definitely does help local producers. So overall, we have been positive. I do like Tata Steel at current levels. We, of course, like Vedanta, and we've been liking it for quite some time. And we believe that, in Vedanta, you get to participate in the entire metal pack and in a very effective way. Of course, icing on the cake will be the demerger as and when it happens.
As and when it happens, right? I mean, that's the... it's I think at the same price where it was May of 2024. April was the last big month for Vedanta. I mean, when it had gone from about 270 to $400. But after that...
Prashant, but I'll have to... No, Prashant, if you look at Vedanta and you look at the Nifty, okay, let's pull that chart up for the last 1 year. Both of them actually have not moved at all, right? But Vedanta, I think, has given close to around 50 rupees of dividend. That's what it's become a dividend machine, actually. Because you look at it, you'll say the stock has not moved. But actually, the dividend from that same time period that you're talking about, May 2024 till date, I think it's around 50 rupees, 45 to 50 rupees, or maybe even 55 rupees. So it's become a dividend machine. So that's what's protecting it, actually, in the near term, that uncertainty on the demerger. But the dividend machine, it's helping shareholders. Shareholders are happy about it. And also the promoter, well, they are deleveraging themselves at the promoter level, Vedanta Resources. So that's why this dividend actually spells good times for them.
But Nigel, how does that compare if you look at Nifty dividends? Like, for example, if you take Vedanta total returns versus Nifty total returns. I think Vedanta would still come out on top, as you said. Yeah. I think the difference will not be as large. Bloomberg will be able to maybe...
No, I'll give you the dividend is around 53 rupees, I think so. If I just look at the time frame that you're talking about, actually it'll be a little more than that. It's more than 56 rupees. 56 rupees on a 440 rupees stock actually will be, it's more than 12%.
No, I'm saying Nifty dividends. I mean, if you are like total returns,
I think it will be unlikely to be 10%.
No, it won't.
So,
it won't. But you're absolutely right. I mean, dividends, of course, have protected. But I mean, at the end of the day, price-wise, capital appreciation is dividends. Of course, is when as I say, you get paid to wait. But the point is, the wait's been very long. In the case of Vedanta, for a while now. Actually, you can go back many years. The business we all know is worth a lot more than what the stock actually trades at. but at some point it's going to start to get unlocked. We'll see. Sudeep, what else? Names like, by the way, do you have a view on names like NetWeb, E2E Networks? There is a news flow as well, which we will address with Vinny in a bit from now. But do you have coverage? Have you looked at these businesses?
I have, and I think the excitement is building because of the entire AI story and the chip manufacturing, which is definitely going to be very hot as far as India is concerned. Our belief always had been that the second wave of beneficiaries of this entire AI wave will be companies in India. I mean, which company and all that we'll have to see. But definitely the first wave has been, of course, the US companies, Taiwanese companies, and some of the Chinese players. But at the second level, I think Indian companies will catch the wave and take them to themselves to the next level. And that's pretty much what is happening. Now, these are not very popular and very, hot companies that way. Both these companies you mentioned, NetWeb as well as E2E. But I think there is a traction and there is excitement. And some of these companies are doing very good work. Some of the unlisted players are also, I understand, doing pretty good work. As far as these two are concerned, I think NetWeb is pretty well established. And I think, even at current level, we feel positive about it. E2E is not that much is known or, researched at this stage. So I won't really comment on that. But of course, the recent developments have been pretty encouraging.
NetWeb is still about 17% away from its high of, which is more than about 3,000 rupees. The stock today after the surge is about 25.36. The other one, Sudeep, making big moves today is TBO Tech. That's the B2B travel platform. So unlike your Make My Trip, Ixigo, Yatra, which is B2C, this is B2B. And they've made this big acquisition in the US, which opens up the luxury market for them, luxury travel. Valuations look okay, 1x price to sales. How does TBO's Tech stack up now after the up move in terms of valuations and the growth profile?
I think it's a very interesting acquisition, as you rightly mentioned. The valuation at which they are doing the deal is also interesting. Of course, this entire sector is very hot, and we strongly believe that this the traction or the upswing in this travel and tourism will continue in the foreseeable future. Under the circumstances, luxury travel and a company having global presence, I think that's a great acquisition. So we are definitely positive on the stock as well as positive on the acquisition which they have done.
By the way, in some other stocks on the move, JSW Cement is tracking a gain of about 4% as we see. And I don't think it's an overall sector-specific rally. It's more of a JSW Cement phenomena. Numbers, of course, came in earlier and now inching towards the highs of the day. Sudeep, hi, good afternoon. How do you find this stock? I mean, it has the pedigree, but if you were to pick cement names, then where would this feature?
Well, we like cement and we have been liking cement for quite some time. And apart from the usual reasons, which was valid till 14th August, I think post the GST reduction announcement, GST rationalization announcement rather, I think cement has become even more attractive. And we do like Ultratech for quite some time. And we still believe Ultratech is a good buy from a long-term portfolio perspective. JSW, yes, interesting, but I don't think I will buy JSW at current valuation. If I have to buy, I'll still go and buy Ultratech Cement. If I have to buy some of the mid-cap cement companies, I'll go for Birla Corp.
Just about 1 month done for JSW Cement from its listing. Issue price was 147. The stock right now is 159. And the other one where you are seeing a bit of pressure is NSTL today. And that's because the lock-in has opened up. And NSTL share price has slipped close to about 3%. So that supply is hurting. Sudeep, thank you very much for joining in. We'll get into a break. On the other side, we'll get you a few BTST calls. Our technical expert will join in.
Okay, welcome back. Let's go across to Mitesh once again. Get final sense of trades that one can look at. Mitesh, for what it's worth, at least there's green on the screen today. Final advice then, and any stocks?
There's quite a good amount of greens, Surabhi. I think both the Bank Nifty and the Nifty are doing well, and metals are leading from the front. I earlier had Jindal Steel, now Tata Steel is a BTST. Keep a stop at about 166. Look for targets of 171 to about 172. And United Spirits, or McDowell's as it was known earlier, that's also reversing after a deep correction. So BTST here with a stop below 1339 for targets of 1370.
Okay, all right, got that. Mitesh, thanks very much. We'll connect again tomorrow morning, bright and early. But for the time being, let's focus on TBO Tech, the stock that we have been discussing. It's done so well today on the back of that US acquisition. Manglam is here to explain the dynamics to us. Manglam.
Well, a couple of things that really stand out in this acquisition. One, the company's paying $125 million, which is up to 1,100 crore rupees, which is pretty much almost all of their cash balance that was there on in their books as of March, which was close to around 1,285 crores. Secondly, this company, which has a network of luxury travel advisors and suppliers, is in a category which is doing well, in a category which already is doing well. So travel is doing well, in that luxury travel is doing even better. What is the revenue addition? As of 2024, the Classic Vacations did a revenue of close to 1,000 crores, $111 million to be precise, and the EBITDA was $11.2 million, which is 10% margins. The company's own margins, however, 16%, and their own revenue is 1,737 crores as of last financial year. So you club both of them, the revenue of the company increases by close to 55%, but there is a slight element of margin dilution. So to that extent, it will be very important to see how they scale the operational performance and the revenues of this company that they've gone ahead and acquired. It's a good acquisition, and the street is responding accordingly. It's up around 15% for the stock.
Thank you very much for that. The street likes the growth aggression shown by TBO Tech. With this, as he said, revenues could go up by more than 50%.
Sorry, the other one in the same line of business, listed much earlier, RateGain.
RateGain.
I don't know if it is on the back of TBO Tech doing well, but RateGain is also has come off quite nicely from the lows, right? 7th of August, stock was at 430 rupees. It's almost 600 rupees now. So that's the other one. RateGain at one point used to grow at, their stated guidance was 50, 60, 70% growth.
But that used to be with acquisitions. Organic was also very, very high. But,
but I think now it's got 10, 15, 20% kind of growth rates.
I think it's in
they're sitting on
single digits.
Yeah, they're
sitting on
cash. And they've been looking for an acquisition for a long time, but it's not doing well. But as if so many other stocks which are bombed out and they're coming back up. So you've got to go stock by stock. I remember Sonal pointed out, did a piece on, I think, was it BGR Energy, right?
Energy, yeah.
Now, that is a definition of bombed out name, which is kind of, doubled or something, as she was pointing out. But is something happening, or is this? So you got to be mindful, not comparing this or that, but there's a fair bit happening in terms of that line of thinking. Where have stocks fallen quite a bit, and maybe there is at the margin perhaps a little bit of turn happening or whatever. So just thought I would point out. So TBO Tech and RateGain, both largely from the same kind of space.
Okay, let's get to the other big mover, and that's E2E Networks. Vinny joins in for more. Vinny.
Hi, afternoon. So yes, E2E Networks, that's the one buzzing in trade, and this is coming after the company has received a letter from Indian AI Mission, Ministry of Electronics of Information and Technology and Government of India. This is for an order for some allocation of GPUs. Mainly this company is, into delivering GPUs, AI related, and that is why in AI hyperscale is their main focus area. This order value is of 177 crores, and that is why a good order win coming in for the company is keeping the stock abuzz. Also in the recent times, they've had a lot of order wins coming in as well. On 26th of August, they had an order win of around 88 crores on the AI front as well. 28th August, there was an announcement coming in of an acquisition they made, and this was also AI related acquisition. So furthermore, pushing their AI story, this is a strategic move that is coming in from the company as well to focus, given that the government's mission is also AI. They also want to focus more in terms of the AI technology as well. Do not forget, in around December 2024, we had seen L&T that had acquired 15% stake in the company, and as on 30th of June, L&T still holds 19% stake.
Okay, all right, Vinny, thanks very much for that. E2E has really been completely up and about today, 10% circuit for the better part of the day, right from the morning onwards. Okay, let's now head to Nigel, who's at the F&O desk. Nigel, the green is getting greener. 150 points up now.
Well, that's right. And the end of the day, this F&O data will be very, very exciting because just going by the look of it, the Nifty bank is outperforming. We are seeing this after many, many trading sessions. And the shorts are heavily stacked in the Nifty bank. The problem is we ain't able to get past that 54,000 mark decisively and move towards a technical mark, the resistance mark of around 55,000. Let's see whether or not we have enough this time around to move up. But otherwise, the Nifty bank outperforming, that's the biggest highlight of today. And that will do the heavy lifting if it got the momentum. So that's an important part to track. If you look at the Nifty options data, well, normally we see this, right? On weekly expiry, we have a bit of a swing factor. Normally that takes place on Thursday. So on Friday, it realigns itself. Now, this time around, on Tuesday itself, we had the expiry that played out. And that's why on Wednesday, we're realigning ourselves. So we are undoing some part of the pain that we saw yesterday from around 1:30 to around 3:30 p.m. in yesterday's trading session. And that's why, in fact, we're seeing a bit of a bounce back. And the options data is quite encouraging. 24,500 put, massive open interest built up out there. 24,600 put as well. Good amount of open interest built up out there. And in an uptrending market, you want to see the nearest possible strike, see a good amount of writing. And that seems to be the case on the put side. On the call side, however, in yesterday's trading session as well, we did see a good amount of writing at around the 24,700 call. And that continues even today, the new contract. This contract will expire in the coming Tuesday. So the premium out there is in that vicinity of around 50 to around 100 rupees, which gives you the levels. Yesterday's high, the 20 DMA, all of that is in that vicinity of around 24,700, 24,750. So that becomes a resistance mark in the near term. The reference point on the downside is 24,400 because we have visited that mark, and from there we have seen a bit of a bounce back. Moving to stocks that are in focus, Piramal Pharma, that's seeing fresh buying in today's trading session, good amount of open interest built up. You have Tata Steel as well, that good amount of open interest built up out there. So fresh buying is what we're seeing on both these two names. However, if you look at Yes Bank, that's one of the smaller counters that's popped up in trade today, and it appears as a bit of a short covering bounce that's playing out on that smaller name. The stock that I'll keep an eye out on when I'm looking at the evening files, post-market hours, will be RBL Bank. And I say this because the open interest as a percentage of market-wide position limit, or MWPL, is moved to around 101% as of 3:05 p.m. And since it's moved over the 95% mark, that's a likely stock that could come into the F&O band. So that's the one that I'll keep on my radar. Back to you.
Thank you. Let's get in Mayuresh Joshi. It's 24,700 in the Nifty now, just getting stronger, 135 points up with the sensex up nearly 450 points, and the Nifty bank literally flying now. Mayuresh, hi. We've seen a lot of big movers in today's trades, some which are bombed out, some names like Ola Electric, where the momentum continues to be there and stocks are moving higher and higher, news-based stories in TBO Tech and E2E, NetWeb, etc. What are you liking right now?
Hey, afternoon, Rima. So I think the screen's green, and I put my background screen as green as well. So remain optimistic on the markets as we speak. I think a couple of stories that we like. One, I think within the mid-cap space, there is a stock called Acutaas Chemicals. Now, they've produced a very strong set of numbers in the quarter gone by. And again, I think the kind of operations that they are into, the expectations in terms of their pharmaceutical intermediate business is expected to remain extremely strong and robust. Their facilities now are also PMDA GMP certified, which means that the Japanese authorities have given them the go-ahead, which is very, very positive in terms of an earnings pedigree. The other element in terms of that specialty chemical business, which is 15%, they've got a joint venture in South Korea, which gets them very, very close to the semiconductor markets in the specialty chemical business. And because a lot of their value-added products are engaged in these line of businesses, semiconductors, battery chemicals, CDMO, I think the expectations that the management has put forth is a 25% growth. Last year, they closed with EBITDA margins of 23%. They've already done 24.5%. If you probably go by what the management is saying, and they grow 25% with a 25% or a 25.5% margin, I think the bottom line growth will even be stronger because there is hardly any debt onto their books, which means the earnings growth that we look at markets with end of more than 20-25%, with ROEs expected to be around 17.5-18%. I think this is one stock, in my opinion, placed in the right sector, placed in the right areas, and the sphere of business that they're probably delivering at this juncture makes us believe that it's a very, very good story to probably follow. The other stock within the auto Ang pack, I've obviously discussed Uno Minda. quite a few times. We do like a stock by the name of SJS Enterprises. It's moved today in today's trade, but our own sense is the kind of numbers that SJS is posting, the expectations in terms of content per car expected to go significantly higher. The kind of value-added technical products that they're probably making, which is around 25% cash-rich balance sheet, about 130 odd crores onto that balance sheet. Again, very, very strong margin profile at 27, 28 odd percent, and expected to deliver strong earnings growth moving forward. Obviously, the tailwind with GST rationalization or auto OEMs can act as enablers in terms of even stronger earnings growth. So being very, very selective, but where ratings, rankings are looking strong, earnings are looking strong. I think these two names from the mid-caps is something that we are lacking in markets.
Okay, that is some names. Mayuresh, hi, good afternoon. Let me ask you for more. Okay, what would be your top 3 GST stocks? They could be from auto. I don't know, maybe Uno Minda could be classified as one within auto. I'm not sure. It could be beyond what you just said. But top 3 GST stocks.
Afternoon, Survi. So I think SGS is something that I've already covered. So it's part of the auto Ank universe. Is what our belief is that it should continue doing well. One, again, the hotel space. Our own sense is hotels as a space should continue doing well. With expectations of GST rationalization on average room rates below 7,500, I think that can be a big enabler for the industry as a whole. And therefore, a stock like ITC is something that we've held in our portfolios. Was Lemon Tree Hotels is something, in our opinion, that is on the verge of a good breakout as we see it in markets with India. And again, the fundamentals are very, very supportive. What they have probably done in terms of their own rooms, the delivery thereof, specifically in terms of the F&B segment, which is contributing decently well. The managed portfolio is doing well for Lemon Tree as well. And the expectations is that they're going to add another 7,500 rooms. On the 10,000 rooms, a combination of 5,500 owned, 4,500 managed rooms, along with the annuity business that they're probably expected to grow at a very, very decent pace. So hotels as a space is something our belief is where the rating rankings and earnings should sustain. The third stock might be from the footwear space. And obviously, I think the ratings are a little bit on the softer side as we speak. This is one space, I think, as the rationalization efforts kick in, specifically in terms of lower priced footwear. And again, I think the sanity achieved in terms of GST rates. Stocks like a Relaxo, stocks like a Campus Activewear, where I think the expectation is that volumes might start coming up very, very strongly, both in terms of rationalization as well as an organic growth coming through, both in terms of rural and semi-urban demand and urban demand kicking in as well. I think the value chain will move bottom up, and therefore footwear stocks, where the risk reward probably seems to be very, very favorable at this juncture, and the valuations as well, along with the placement as we see it on our evaluation charts. I think a couple of these stories can also perform well once the new rates probably kick in.
Okay. All right, Mayuresh, stay on. We'll come back to you for some more questions. In the meantime, we have to take a break. But in the meantime, here are some comments that came in from Mark Mobius, chairman of Mobius Emerging Market Opportunities Fund. He spoke about Trump's 50% tariff on India and said that he expects India and the US to negotiate trade tariffs in the next few weeks. Take a look. We'll be back with more in just a bit.
I think, Trump has gotten exasperating news from Russia. There hasn't been any decline in the situation in Ukraine, and this has made him very, very frustrated. So he's taking it out on India. He's hoping that India will help. But I'm afraid his hope is going to be shattered because obviously India doesn't want to give up its imports of oil from Russia. I think he will be disappointed. And now, of course, we've seen Modi holding hands with Putin. That is not going to be very encouraging to Trump. So obviously, the U.S. is going to have to step back. And I think probably they will begin to realize that India is not going to give in to the pressure. I think Modi has given a clear message to Trump that he will not be pressured. And I think for good reason. I think India has got to stand up to this kind of imposition in terms of trade. I think they will reach an agreement. I would give it maybe 2 or 3 weeks, and you'll see the U.S. coming to the table again and negotiating something with India so that this is not going to take place. India may make some small concessions, but at the end of the day, it'll be the U.S. that will have to step back.
Welcome back. Well, the markets actually are continuing to hold up. Today is going to be a day where we go home at the highest point of the day. And as I said earlier, encouraging part is the Nifty Bank continues to do well. Mayuresh Jayashree is still with us. Mayuresh, what do you do with these capital market plays? BSE at 3,000, everyone was falling in love with it. The stock has corrected closer to 2,000 rupees. In the unlisted market as well, NSE was running away. I think that's corrected closer to around the 2,000 odd mark. How do you play the capital market theme? Because in the near term, there could be speed breakers. But in the longer term, there's tremendous potential as the equity cult is developed here in India.
Afternoon, Nigel. Oh, absolutely. No two ways about it. But at the current juncture, I think the best play or a proxy to capital markets might be these asset managers. And therefore, Nippon AMC or HDFC AMC probably might be a safe bet at this juncture as we speak, because there is still uncertainty in terms of how volumes will play out for most brokers because of the expiry tweaks that have probably happened and the regulatory changes thereof. And typically, I think that will also have a say in terms of the exchange volumes. As far as the exchanges are concerned. However, I think for asset managers in general, I think the SIP trend continues. The expectations in terms of them creating a very decent asset base. And again, the operational costs have now largely plateaued off and stabilized, which now means that it acts like a funnel. I think anything which keeps on coming in to the system, which will keep on coming in through SIPs, I think that will have a huge say in terms of their managed AUM. And because costs will remain stable and rationalized, I think the bottom line growth can be far larger because of costs under control. Therefore, I think asset managers like HDFC Nippon is something that at least our ratings and rankings and our sector rotation graph indicate might continue doing well as far as capital market participants.
Okay, all right, Mayuresh, just hang on. This is an update coming in from Reuters. Jane Street has filed a case against SEBI at SAT, saying that SEBI is not providing documents and data it's using to make its case of market manipulation. Okay, we remember that this case, the big order that SEBI had put out against Jane Street. After that, it had allowed Jane Street to get back to the market, based on certain conditionalities, strict compliance with, of course, a lot of the details. It seems now that Jane Street has gone to SAT. Not quite sure if it's the same case. Obviously, they would have taken to SAT because you can't file a fresh plea in SAT directly. It seems to be the same case, saying that SEBI is not providing all the documents based on which the order was issued in the first place. Let's see. This is an ongoing matter. Mayuresh, final 2 minutes. The whole metal space. Any topic here? Big mover today.
So I think Hindalco continues doing well, and in our opinion, again, I think once the global operations stabilize at the Novelis end, you'll largely see that next year's financial performance for Novelis should be relatively better, and the domestic performance is expected to continue doing well. Obviously, I think how aluminium prices move is going to be dependent on global demand supply, but I think they should also stabilize going forward. And because of their backward capacities, when it comes both to alumina and other raw materials, I think they are a tad bit better off in terms of EBIT and absolute EBITDA per ton than they do.
Mayuresh, thank you. Just want to wrap out today's trading session. Markets have extended their gains and the Nifty is closing above 24,700 ahead of the GST Council announcement tomorrow. There was considerable strength. We had a flattish opening, but markets only built on the momentum, 0.5% up on the benchmark indices. The big winner today was the Nifty Metal Index, ending with a gain of more than about 3% and higher for the third consecutive day. This week, the Nifty Metal Index has seen an up move of nearly 6% odd. On the way down, I think there's only the IT index which stands out in terms of losses, ending firmly lower, 0.8% gone. So stock winners include Tata Steel, Hindalco, JSW Steel. Top three are from the metals pack. Nifty Bank provided its support. So State Bank of India, Edison Bank, HDFC Bank, Kotak Mahindra Bank also supporting the markets on the way up. On the way down, it was Infosys, Nestle, Wipro, HDFC Life as some of the laggards.
Yeah, IT also a bit of a weak spot today. On the mid-cap screen, actually not a bad day at all. You had almost 2,000 stocks advancing, about 900 stocks declining. And some of the interesting movers included Ola Electric once again, 11% up on Ola. You had Piramal Pharma about 7.5% higher. And then the stocks we've been discussing through the course of the show as well, TBO Tech, NetWeb, E2E Networks. a lot of these names on the upside today. And many of them, of course, news-based because they've got fresh order wins and TB on the back of that acquisition. Rate gain, Yatharth Hospital, quite a few names actually on the upside. SJS Enterprises, which is a pick that Mayuresh just highlighted. Many of them doing well. Bank Nifty actually one of the best performing indices of the day. Metals takes the lead, but then banks are coming in as a close second, about 0.7% over there. All in all, not a bad Wednesday. The Nifty managing to inch higher and close above 24,700. Well, with that, it's a wrap on this edition of Closing Bell. Thank you so much for being with us, but do stay tuned. We have Markets Forward taking the action ahead.